What if I told you that right now in 2026, the smartest investors in the world are looking at their screens and getting flashbacks, not to 2008, not to COVID, but to the year 2000, the dot-com crash, the one that wiped out 80% of the NASDAQ, the one that erased trillions of dollars and took 15 years to recover from. Because here's the thing nobody wants to say out loud. The setup looks almost identical, and today I'm going to show you exactly why. Point by point. Okay, quick history lesson. Don't worry, I'll make it fast. It's 1999. The internet just became a thing, and everyone, your uncle, your taxi driver, your dentist, is buying tech stocks. Companies are going public with zero profits, some with zero revenue, some with literally just a website and a logo. And their stock prices are doubling and tripling overnight. Between 1995 and its peak in March 2000, the NASDAQ rose by 400%. Some stocks went up over 1,000% in a single year. Wikipedia people weren't buying these stocks because the companies were making money. They were buying them because of the story. The story was, the internet is going to change everything. And you know what? They were right. The internet did change everything. But here's the brutal lesson that everyone forgot. Being right about the technology doesn't mean you're right about the price. By 2002, the NASDAQ had lost nearly 80% of its value from its peak. Thousands of companies went bankrupt, and trillions of dollars in market value evaporated. Medical executive post Cisco, the most valuable company on earth at that time, lost 80% of its stock value. Amazon fell 90%. Regular people who had poured their savings into tech stocks lost everything. So, why are we talking about this in 2026? Because history is doing that thing it loves to do. It's rhyming. In 1999, the magic word was .com. Slap it on your company name, and your stock price exploded. In 2025 and 2026, the magic word is AI. Companies mention artificial intelligence in earnings calls and add billions to their market caps overnight. Investing.com. In 2025, the word AI performs the same magic that .com once did. Investing.com. Let me give you a number that should make your jaw drop. The ratio of total stock market capitalization to GDP now stands at 232%, exceeding 1999 levels and the 200% threshold, where Warren Buffett said investors were playing with fire. Fortune, let me repeat that. We have exceeded the valuation levels of the dot-com bubble, and it gets worse. In late 2025, 30% of the S&P 500 was held up by just the 5 largest companies, the greatest concentration in half a century. Share valuations were reportedly the most stretched since the dot-com bubble. The Case-Shiller price-to-earnings ratio for the U.S. market also exceeded 40 for the first time since the dot-com crash. Now here's where it gets really familiar. In the dot-com era, investors threw money at anything with a website. Didn't matter if it made sense. The logic was, get in early, ride the wave. Today, same psychology, different technology. Big tech plans $650 to $700 billion in combined AI capital spending for 2026 alone. Intuition Labs, $650 billion. In 1 year, Morgan Stanley estimates that U.S. retail investors have funneled more than $700 billion into equities since January, a record surge, roughly 5 times faster than during the 2000 bubble. Investing.com, 5 times faster than the dot-com bubble. Let that sink in. And what's the return on all this spending? A report from MIT's Media Lab stated that despite $30 to $40 billion in enterprise investment into AI, 95% of organizations are getting zero return. Wikipedia, 95%, zero return. This is literally the same story as 1999. The internet was real, the technology was real, but most of the companies built on it, total money pits. The question isn't, is AI real? Of course it is. Now, nobody, and I mean nobody, knows exactly when or how this plays out. Anyone who tells you otherwise is selling something. But here's what the data and the experts are saying. Analysts now identify 2026 to 2028 as the highest risk window for a significant AI stock correction. Intuition Labs. In Samuel Benner's 19th century market cycle, 2026 aligns with what he called a panic year, the point when optimism turns to realization and the market begins a multi-year correction. Investing.com. And the macro backdrop isn't helping. Trump's tariffs, a government shutdown, JP Morgan warning of a complex mix of geopolitical fractures, high asset prices, and sticky inflation risks. And yet markets barely blinked. Liquidity now outweighs logic. Investing.com. That last part is the most dangerous sentence in finance. When nothing bad can shake the market, that's usually when you're closest to the edge. 3 scenarios people are discussing. 1. Soft landing. AI revenues catch up to the hype. Slow, grinding correction of maybe 20 to 30%. 2. Slow leak. The B. Bubble deflates over several years, like a slow puncture. Painful, but survivable. 3. The 2000 replay. A sharp crash of 40 to 80% in overvalued tech. Regular people get hurt. The strongest companies survive and dominate the next decade.